Welcome to our second quarter MarketCast. Last year, the Fed said that it planned to fight inflation and that it also would try to steer the economy to a soft landing that avoids a recession. They knew it would be a difficult task because past attempts at soft landings have rarely succeeded. But here we are now, a year later, and it looks like the Fed just might succeed in bringing inflation down to the 2% target while preserving at least some modest economic growth. Will the Fed be able to complete this very delicate balancing act? Unfortunately, there are still a lot of challenges ahead. Let's take a look at how markets and the economy have been responding. This quarter, U.S. large caps led stocks higher as the Federal Reserve put its rate hikes on pause, and artificial intelligence stocks surged on rising optimism for the technology. Yet, despite the rising stock market, the U.S. economy is expected to remain sluggish, with GDP growing well below its normal rate through next year. And bond prices headed lower in the first quarter as inflation remained well above target, and the Fed said that more future rate hikes were likely. So I think the big question is, will this year's stock market rally be able to continue, or will additional rate hikes and slower growth lead to a correction? To explore these questions, I'll turn it over to Senior Investment Advisor David Janec.
Thank you, Reegan. This year's rally in U.S. large-cap stocks was remarkable. It was led by 7 technology giants: Alphabet, Amazon, Apple, Meta, Microsoft, NVIDIA, and Tesla. The combined performance of this handful of companies accounted for the overwhelming majority, 73%, of the market's year-to-date performance, but they represent only 23% of the index weight by market cap. And what's particularly notable is that these companies also happen to be the leading developers and users of artificial intelligence. Since last year's record-setting launch of ChatGPT, a chatbot driven by artificial intelligence, expectations have been soaring regarding the potential impact that AI can have on productivity and the economy. For example, according to Goldman Sachs, artificial intelligence technology has the potential to raise global GDP by 7% over the next decade. And many analysts believe that AI can also help to reduce inflation by reducing costs and increasing productivity. And that could be good news for investors because inflation has lately been a major challenge to financial markets. Looking at inflation, here we can see that after peaking a year ago, the U.S. annual inflation rate has been declining, led by falling energy prices. This general trend towards lower inflation has been good for stocks, and it's raised hope that the Fed's tightening cycle may be nearing an end. And in fact, in June, the Federal Reserve decided to hold the Fed funds target rate steady at 5 to 5.25%. But the Fed also said that additional rate hikes were likely. So we think that the Fed's balancing act is becoming increasingly delicate as it tries to steer the economy to a soft landing. Now, let's take a closer look at the economy. Here we can see that the U.S. economy is running slower than a year ago, with many indicators lower than their year-ago levels. And this is consistent with the gross domestic product forecast that we're seeing. Real GDP growth is expected to decline from 2.1% last year to 1.1% this year and 0.7% next year as tighter credit conditions weigh on demand for goods and services. But there's an important outlier. In June, consumer expectations rose sharply on renewed labor optimism as payrolls rose more than expected. And this strong job market is one of the main reasons why the Fed thinks it may need to do more rate hikes. Because, as we know, interest rates are the Fed's main lever for steering the economy. During this recent period of rising interest rates, 2 sectors have been squeezed hard: real estate and banking, and we can see it in their recent performance. The worst performers have been regional banks, which have higher exposure to commercial real estate loans than their larger peers. Private real estate has also been under pressure, but private appraisals have tended to be slower to adjust to changing market conditions, and this tends to smooth the index. So, if more Fed rate hikes are likely, we could soon be seeing more volatility in the banking and real estate sectors. And higher interest rates have also been putting a squeeze on the federal government's ability to service its debt. The U.S. Congressional Budget Office projects significantly higher annual budget deficits and interest expense in the coming years. The Government Accountability Office has found that the government faces an unsustainable long-term fiscal future and that action is needed to change the unsustainable fiscal path. And in May, ratings agency Fitch put the U.S. AAA sovereign debt rating on negative watch. So we're seeing that the Fed's fight against inflation may also be creating some serious challenges. And it's challenges like these that remind us of the importance of portfolio diversification. To build a diversified portfolio, we need to understand the historical return and risk characteristics of each asset class. For example, which investments have had the highest average returns over time, and which ones have had the most consistent returns over time. In this chart, we can see how cash returns after inflation have tended to fall within a narrow range, while bond and stock returns have varied much more widely. For example, cash has historically provided an annual after-inflation return in the range of -2% to +2% more than half of the time. And it's been rare for cash to earn a double-digit return, either positive or negative. Stocks, on the other hand, have frequently earned double-digit returns, both positive and negative. But stock returns between -2% and +2% are not very common. So, when we build portfolios, we keep these historical relationships in mind as we monitor the markets and form our tactical positioning views. And now, for an update on our tactical views, I'll turn it back to Reegan Rae.
Thank you, David. As the Fed continues to fight inflation by holding short-term interest rates high, we're looking to take advantage of the opportunities that may come our way. We're continuing to favor cash and low duration for income and stability, and we're taking a cautious view toward longer duration fixed income. We like hedge strategies for risk management and as a source of dry powder for potential future equity purchases. Our view toward equity is neutral as we expect to see some additional Fed tightening in the coming months. But as always, please keep in mind that markets are dynamic and that our views may change as new events unfold. Your advisor will work closely with you on specific opportunities as they become available. Lastly, if you haven't visited our blog lately, now's a great time. In it, you can find a link to a Money Life with Chuck Jaffe podcast featuring Brian Shipley discussing behavioral economics, plus Arnerich Massena's latest awards, including recognition from Think Advisor for thought leadership and education. Also, tips on protecting yourself from cyber fraud and an Arnerich Massena article featured in the Portland Business Journal about bonds. If you're interested in subscribing to the blog to get email updates, please let your advisor know. Thank you for joining us today.